President Trump has promised reciprocal tariffs, but the market isn't quite sure if they're really happening. The US president said on Friday he'd asked his team to look into tariffs on every country that imposes any duties on the US, potentially breaking down the WTO framework entirely. They have until April 1st to report, though, and the US team's apparent willingness to kick the can down the road has brought the biggest Trump trade, the strong dollar, lower in recent sessions. Tim Graf is head of macro strategy at State Street. Tim, are currency traders at least concluding these tariffs might not happen, or at least not imminently?
I don't know if it's a question that they might not happen. I think when it comes to reciprocal tariffs specifically, some of the rates that U.S. corporations pay or U.S. importers pay they're not as big as some of the large percentage amounts that we've talked about, above 25%, say. So I think it's a case that these maybe aren't as extreme when it comes to the tariffs that are paid here that would then be reciprocated by the U.S. I think also the contingencies we've already seen to some of the tariffs announced thus far reduce perhaps some of the worst impacts, or at least in the market's mind, think some of the worst impacts might be mitigated. So I think it's more that rather than that they won't happen.
Do you think, though, that markets should be readying themselves for imminent retaliation, especially from the EU?
Possibly a little bit, but again, this is reciprocal. So reciprocal in theory means what you do to me, I do to you. And so unless other countries really wanted to escalate a trade war, which I suspect very few do, I don't know if you'd see too much retaliation other than maybe spreading the focus of tariffs on US exported goods to make it a broader basket. But again, that would just bring into the case the reciprocity element. And so you would get perhaps some acceleration. But I don't really think it's in too many interests of the exporting community to the US to really retaliate or to really accelerate that trade war.
Even so, we did last week see an unexpected tick up in US inflation. Do you think markets should be pricing in more of that on the back of possible tariffs?
I think probably to a degree, yes. Inflation expectations so far have been pretty well contained. You have seen small rises, but they've quickly reversed. And as you pointed out, the inflation data itself, especially given the time of year where you see annual price resets, and they've been greater than what we potentially have anticipated in the pre-pandemic era, that has factored. And I think you probably do need to see inflation expectations maybe a little bit higher to account for this. I do think there is some complacency, or at least some underpricing, that this trade war could maybe get out of hand, even if that's not the central scenario.
Also, of course, the Trump administration upended the market's expectations of what might happen in Ukraine over the course of the weekend. And for Europe, that's significant, of course, not just politically, but also economically. What might the consequences be of a big uptake in defence spending, do you think?
Well, I think it would be potentially positive for the European growth cycle. I think you're actually seeing a lot of optimism, no matter what the outcome is, and it may be an outcome to the Ukrainian peace process that people don't like. At the very least, it does potentially solve the situation temporarily, maybe, but it does provide a temporary relief. And greater defense spending ultimately becomes expansionary fiscal policy for Europe. And it also benefits the U.S. as well, given so many defense contractors are U.S. based. I think there's potentially a positive growth story to come out of this, ironically, as that might be.
Would it mean an increase, though, in European countries already heavy borrowing?
It certainly would. And there are certain countries who probably are at limits of what they can possibly do, the likes of France, potentially Italy. But Germany, there's been lots of talk about reform of the debt brake, and Germany has ample fiscal space to increase spending, and given it is the largest economy in Europe, would potentially be the leader in this. So yeah, I think it does allow for that expansionary fiscal policy movement to continue.
That was Tim Graf of State Street. Don't forget, you can watch more videos on Reuters.com.